Thank you, Kirby, and thank you, David. It's my pleasure to be here again today. This is the third time that I've attended this event. Last year when I was here, I had the opportunity to be up here with our executive director, Irv Holter from DOLA, and Jason Schrock from OSPB. Kirby invited both of them to come back this year. Unfortunately, Jason had been traveling quite a bit recently, and he provided some slides to me nicely and said, I trust that you can convey the message from OSPB. So those slides are included at the end of my presentation today. And Irv right now, he has taken David up on that challenge and has been out quite a bit. He's put over 30,000 miles per year on his car since he's been the executive director. He's tried to make it, and I believe he has been successful in making it to all 64 of Colorado's counties, and really has done a lot of outreach and seeing the work that DOLA does firsthand and seeing the need for those DOLA funds as well, which are actually federal mineral lease funds and state severance tax funds that DOLA is responsible statutorily for distributing. Right now, Irv is back in Denver fulfilling one of those big obligations that he has. The energy impact hearings are going on right now. So a lot of local communities are coming down to Denver, pitching their grant ideas to the committee and to Irv. And unfortunately, there's a dwindling pool of money that is being distributed. So it makes that job even more difficult, as the need is still very great throughout the communities, but the amount of money that can be distributed to meet that need is less now, as I'll share with you at the end of the presentation. So Irv regrets that he was unable to make it here today to speak to you, but he is fulfilling a very important responsibility as executive director of DOLA in helping to determine what communities are going to receive those grants. So I'll jump right into my presentation, give you an idea of what we're going to be covering. It's basically going to be four big things. I'm going to be talking about oil and gas production, both in Colorado and in the United States, to put it into a little bit of context, looking at where we've come over the past 8 to 10 years in some cases, and then looking forward over the next few years so we know what to expect from an industry perspective, both in what the price of oil and gas is going to be, whether it's going to be profitable for drilling and continued extraction, and then also from a local government perspective to give you an idea of what kind of property taxes that you can expect to receive from that production, and then also tail that into the production and the price, which is one of the main determining factors of a lot of those severance tax dollars. I'll be talking about industry employment changes. As we well know out here on the Western Slope over the past few years, it's been a difficult time for the industry. We've seen a shift in employment that's gone to northeastern Colorado and Weld County, primarily at the expense of a lot of Western Slope counties. And we'll also see how employment has fallen substantially over the past couple of years in the wake of the lower natural gas and oil prices that we've been facing. I do have some positive news when we look at price projections over the next few years in production. Expect prices and production to both be up from where they have been in 15 and 16, but nowhere near where they were in 2014 in terms of prices. Production, however, should be continuing to go up. And then finally, that will all kind of try to pull it together and looking at some of those state revenue projections that are really determining our severance tax dollars that we have flowing into the state that get redistributed by DOLA and that go on to fund the Department of Natural Resources, and also those federal mineral lease dollars that are collected by ONRR and then redistributed by DOLA as well. So I'm going to start again by looking at crude oil production. This chart looks from January 2010 through January 2017. The United States is shown in blue, and their production in barrels per day is shown on the left-hand axis. The Colorado production is shown in red, and its total is barrels per day is shown on the right-hand axis. One of the things that you'll notice is back in 2010, Colorado accounted for about 1.6% of all oil that was produced in the United States. You'll notice that red line went up at a much steeper pace and much steeper slope than what the blue line did. Both were increasing, but Colorado's oil production increased quite a bit faster than what the United States oil production did overall. So by the time we get to 2017, Colorado is now accounting for 3.4% of all oil production that's happening in the United States, or 3 out of every 100 barrels that is being produced in the U.S. are coming out of Colorado. It's significant important to note that production has peaked in both Colorado and the U.S. U.S. production peaked at just over 9.6 million barrels per day in April of 2015. Colorado peaked a little bit later in August of 2015 at 357,000 barrels per day. Since both of those have fallen pretty substantially, U.S. production is down by about 8%, or about 800,000 barrels per day, and Colorado production is down even more significantly. It was down about 17% from that peak. At the end of December, our production was about 292,000 barrels per day. It has trended up a little bit from there in the month of January of 2017. That's the most recent data we have available. Hopefully that will continue to rise. I do think that some production figures will show that increasing as well. U.S. Production troughed in September of 2015. So total production barrels per day in the U.S. in 2015 was about 9.4 million barrels. It did trough in September of 16 at less than 8.8 million barrels per day. We do expect, or the EIA expects, that U.S. production will average about 9.2 million barrels per day in 2017, and then increase up to just under 10 million barrels per day, 9.9 million barrels per day in 2018. So that's a really good sign for future production overall in the United States, and we expect Colorado production will follow that trend overall. But one trend that we do see on this chart, looking at annual production now, this is in millions of barrels produced in Colorado annually, is that we essentially had an exponential increase almost in our oil production from 2010 to 2015. A couple of these advances that were technological advances that really drove this were increased hydraulic fracturing, and then really what it was lateral or horizontal drilling that started to come on the scene in 2012, 2013, and now by the time we get to 2016, accounted for 2 out of every 3 wells that was being drilled in the state was a lateral or horizontal well. So it was a lot more productive, and even though we were having fewer wells being drilled, we're getting a lot more production out of those wells. One thing that you do see is that in 2016, we snapped a 15 consecutive year streak of increasing oil production and had a drop in our overall production. It was about 11 million barrels according to EIA data. The next slide I'm going to show you shows COGCC data, which shows the drop wasn't quite as significant, but the reason for that is they have a slightly lower total production in 2015. So after increasing by about 30% per year from 2010 to 2015, we saw roughly about a 9% drop overall in our 2016 production. The real story behind the production, though, comes from Weld County. This looks at our top 6 oil-producing counties and the total amount of oil produced per year in those counties, and the big blue line that you see on the bottom is Weld County. Weld County's production has increased substantially. At the beginning of this chart, they accounted for about 2/3 of all oil that was produced in the state. Rio Blanco County has been pretty steady at a second right there, but their total production has been dwarfed by the amount of increase that we've seen in Weld County overall. The other counties that we see where we see a substantial amount of production are only about 1 million barrels or so on average over the course of the year. That's Garfield, where we are now, Arapahoe, Lincoln, and Cheyenne counties. We do have the 2017 forecast that DOLA's put out on this chart as well, and we are expecting a slight increase in 2017 of about 2.5 million barrels of production overall in 2017 as prices recover some from the lows that we've seen in 2016. I'm going to shift gears for a minute now and talk about natural gas production. Again, the U.S. production is shown on the left-hand axis, and the Colorado production is shown on the right-hand axis. And really what we see here is a tremendous increase in production of natural gas in the state of Colorado. In 2000, we accounted for about 4% of all gas that was produced in the United States. By the time we got to 2012, we were up to 7% of all gas that was produced nationally. But one thing that you notice is 2012 marked a peak for Colorado. Then we since trended down a little bit over the past 5 years. While the national production continued to increase. The nation's production peaked in 2015. That snapped an 11 consecutive year increase in production for the nation, and national production was down about 2.5% last year, while Colorado production was essentially flat, edging up just a little bit overall. But the real story, again, behind natural gas production, if we look at it by the counties, is the ascent of Weld County in terms of natural gas production. And Weld County in 2016 displaced Garfield County as the largest natural gas producer in the state of Colorado. If we go back to 2012, in Colorado, Weld County produced considerably less amount of gas than Garfield County did. Garfield produced about 2.6 times the amount of gas that was produced in Weld County. But a lot of the gas that's coming out of Weld County is associated gas that's coming out from the oil wells that are being drilled there. They're now being much more successful at capturing that and getting that gas to market. So in 2016, Weld did surpass Garfield and produced about 22% more gas than what was produced in Garfield County. You'll notice that 2012 marked the peak of production in Garfield County, and it's since trended down substantially, as it has also in La Plata County and Las Animas County as well. So those counties are down anywhere between 25 and 42% from their peak production earlier. If we look at other states such as Texas and Wyoming, they've seen a much more significant decline in their gas production, but it's really Weld that's allowed Colorado to maintain our gas production over the past few years and not have it drop as substantially as a lot of our other western states. And one of the reasons why western states' production has dropped so significantly and U.S. productions continue to increase or stay steady is because a lot of that gas has been shifted back to Ohio and Pennsylvania and the Marcellus and Utica shale plays back there. It's not all bleak, though, for Garfield County. This shows our total amount of wells that were permitted in 2016 by the Colorado Oil and Gas Conservation Commission. There were about 2,835 wells that were permitted. 60% of those wells were in Weld County, but over a quarter of them were permitted here in Garfield County. Some of our other smaller producing counties, La Plata, where we get some natural gas from as well, accounted for about 3%. Adams is a growing oil producer. They were about 3% of all wells. And then Rio Blanco at 2%, and then Jackson has been kind of a surprising county that's had a lot of production that's been occurring out of there for oil recently. If you do look, all the other counties in Colorado only had about 100 wells that were drilled, so those were also ran. So production has really been concentrated in just a handful of counties where the profitability is there at these lower prices, and I'll cover some of the prices here in a minute. But first, I want to talk about those mining jobs that I mentioned earlier. This chart shows the Colorado mining employment as reported by the Colorado Department of Labor and Employment on the left-hand axis, and that's shown in blue. And the price of oil is shown in red, and that's the price of oil per barrel of WTI. One of the things that you'll notice is that mining employment saw a pretty significant increase from 2010 through most of 2012, and then again ramped up significantly to the end of 2014. There is about a 6-month lag between a drop in the price of oil or natural gas and a decline in our employment in oil or mining production overall, or mining employment overall. So you'll notice that back in May of 2014, oil was still trading above $103 a barrel. Hard to imagine that now that it's about half that amount, but then it subsequently fell to about $50 a barrel or so by January of 2015. Mining employment peaked at just under 36,000 at the end of January and has since fallen by about 13,900 jobs, or 38%. It appears that mining employment has reached a trough in December of 2016, and our employment is edging up slightly throughout the first part of 2017. One of the reasons for that is really because oil hit a trough in February of 2016 at an average of $31 a barrel, $31.74, and there were many times in many days in the month of February when oil was trading well below $30. So we've come up quite a bit from those lows. I'm encouraged by a couple of things. One thing is that Oil has been pretty range bound in the lower to mid 50s throughout 2017. The other thing that we're seeing is our rig count is increasing substantially. Nationally, the number of rigs that are drilling has doubled. According to the most recent Baker Hughes count for the middle of April, we're up to about 968 rigs that are drilling nationally. Of those, 28 rigs are drilling here in Colorado. That's a 60-some% increase from April of 2016 when we only had 17 rigs drilling overall. We kind of bottomed out in our number of rigs that were drilling in May of June of 2016, and now we're on the increase again. And in fact, a couple of weeks last month, we had 30 rigs that were drilling overall. So that's one thing that gives me encouragement. The other thing is looking at the unemployment insurance claims that were filed. This data comes from the Colorado Department of Labor and Employment, and it looks at the total number of claims that were filed from oil and gas workers only. If we added our friends in the coal fields and other metal miners who might have lost their jobs over the past few years, there would probably be hundreds, maybe thousands of more claims onto this as well. But if you look when this chart first starts at the end of 2014, the number of claims that are occurring per month are less than 100. When we get to 2015, that claim activity spikes. Really, you see that incredible spike in February of 2015. Throughout 2015, we averaged we had a total of over 5,200 claims that were filed by oil and gas workers. In 2016, that number was down a little bit. It was 3,300, and most of those claims were front-loaded in the first half of the year. One thing that really gives me encouragement is we look over at the far end of this chart, and the fourth quarter of 2016, we see that the level of claim activity is back down below 100 again, which would probably be a normal level of claims activity, meaning that the industry is no longer laying off workers. They're beginning to hire workers. But I'll share with you in just a couple of slides how some of those industry companies are reporting some trouble with hiring workers, as not all these laid off workers are coming back. So the impact of the oil and gas jobs, well, it's been substantial on our state. Fortunately, we're a rather diversified state, so unlike Wyoming, North Dakota, we haven't seen losses that have been as great in terms of employment or personal income, but our overall job growth has been affected. For 3 years, we saw job growth north of 3%, 2013, 2014, and 2015. In 13 and 14, oil and gas was adding thousands of jobs to our job growth, but in 2016, we lost on average over 7,000 oil and gas jobs. And those are well-paying jobs that pay well over $100,000 a year. This has had a negative impact on our personal income growth as well. That's reported by the Bureau of Economic Analysis. Our personal income growth was 3.9% in 2016. That is just about 0.3 of a percentage point above what the U.S. average was, and ranked us as the 15th fastest growing state in terms of our personal income. Now, if we look to our neighbor to the north, Wyoming or North Dakota, where oil and gas is a much bigger player there in their overall economy, they actually saw negative personal income growth. So still being positive and still being above the U.S. average is good, but it's a kind of a retreat from the past few years where we had faster growth and were closer to the top 10 and had more overall personal income gains. More locally here on the western slope, where we have a lot of counties that have large concentrations of gas, their situation looks maybe more like Wyoming, where they've had large drops in both assessed values that they're getting from property taxes. They've also seen job losses, and some counties like Rio Blanco, just to the north of us, have also seen losses in population as well. Now I'm going to put on my demography hat for just a minute here and let you know that the state added just over 91,000 people in 2016. That was a decrease from 2015 when we added almost 100,000 people. One of the reasons why our net change in population was down was because our net migration was down. We had about 61,000 people on net who moved to Colorado in 2016, down from almost 69,000 people on net who moved here in 2015. If you look at that first number on the top of the screen, that's 7,200 oil and gas jobs that are lost, and look at that change in net migration, they have a lot of correlation together. Now, I'm not saying that everyone who moved out of the state or the difference of that net migration was due to oil and gas workers who moved out of the state, but there is some industries or some companies within the industries that are reporting problems bringing back those laid off workers. So perhaps they did either move on to a different industry where they're working, where there might be a little bit more stability, albeit lower pay as well, or maybe they moved to a part of the country where the cost of living is a little bit lower as well. And the other issue is that companies have been forced to become more efficient. This is a positive from the industry perspective, as that they can now break even or turn a profit at lower oil and natural gas prices, but it also means that they need fewer workers to produce the same amount of oil and gas that they did in the past. So when we talk about the recovery in employment, I think that it's going to be more in the hundreds of jobs that are being added in oil and gas over the next few years, as opposed to the thousands of jobs that we saw during the big expansion period in the first half of this decade. So now I'm going to move on to price, production, and revenue forecast for the last half of my presentation now. And this data comes from the Federal Reserve 10th District Energy Survey that's conducted. And the 10th District covers 5 states and the northern half of New Mexico, in addition to Colorado, Oklahoma, Wyoming, Kansas, and Nebraska is included in here. So it's not just Colorado specific, but it does give you an idea of kind of what the industry perspective is on the prices that they need to be profitable. Now, the first figure that you see here on the first question that they asked the industry is, in the first quarter of 2017, what price per barrel did you need to be profitable? The answer to that question was $51 a barrel. The good news is, throughout most of the first quarter, oil prices were above that. So most companies were profitable, but you see the range there in blue. Some companies were profitable at as low as $35 a barrel, but then there are other companies that had higher costs that needed up to $70 a barrel to be profitable. The next bar over that you see asks, what is your price expectation for the WTI in 6 months? $51 again was what most people expected for WTI to be trading at in September of 2017. And the range was a little bit narrower here. There were still some people who thought it might fall down to as low as 38, and a few who were a little more bullish, thinking it could be as high as 60. A year from now, that would be the first quarter of 2018, price expectation on average was about $54 a barrel from the survey respondents. The bearish people thought it could be down as low as $40 a barrel, and some of the bulls thought the range would be a little bit higher, maybe $62 a barrel. Going out 2 years, looking at what prices would look like in 2019, $60 a barrel was basically what the industry respondents said. I'll share with you in a few slides at 60. Also, what the Moody's and the EIA, or Moody's is thinking that the price per barrel will be. EIA is a little bit less than that overall. The range, again, lower bound about $40, upper bound getting up to $70. And then when we look out 5 years, in 2022, the average survey respondent thought that price per barrel will be $69 a barrel. Still a far cry from where we were in 2015 when we were up, or 2014 when we were up over $90 a barrel on average. But there are some bulls who think that we could be up on that 90 range again. And again, some of the more pessimistic respondents who thought 40 could be the lower bound of where oil is trading still 5 years from now. They asked the same questions for natural gas. $3.38 per million BTU was the profitable price for respondents overall. That range was from as low as $2.50 to up to $4.50 for many companies. Unfortunately, when they looked out and asked what they thought that price would be in September over the summer when demand falls a little bit, they thought that price would be closer to $2.85 per million BTU, and a lot tighter range in the responses there overall. A year from now, not as optimistic either, just over $3 per million BTU overall. But 2 years from now, we're getting back up to about $3.22. The bad news is that's still below what the profitability price is for many companies that have responded overall. But when we get out 5 years, we're looking at about $3.64 per million BTU, which would be above the profitability price for many of the companies, and hopefully that profitability price will continue to decline. When they last asked companies this question in the third quarter of 2016, the average profitability price was $3.45. So it is trending down, and we've seen that happen. Same thing with the price per barrel. It's fallen from $54 per barrel down to $51 per barrel. So that is a positive overall. One concern, and I mentioned this a little bit earlier in the presentation when we were talking about the employment perspective, is the concern about labor right there. Concerns limiting near-term growth and activity. Over a third of respondents reported that they had concerns about labor shortages, with several of the firms saying that laid off experienced workers were not returning, so that they were going to be forced to train new employees. And this is bad from a productivity perspective because you're taking employees that are very experienced that could be out there and really helping to return to the firm's bottom line and taking them off of that most productive task that they're doing, forcing them to train new employees that they have. And so that's a negative from the firm's perspective, and that will also increase their cost overall. But a positive is the biggest bar that you see on this chart is the largest portion of respondents reported that they didn't have any concerns overall. So now I'm going to change gears and go back to our forecast a little bit. Again, this looks at the Colorado oil production in thousands of barrels on the blue axis, and those are the blue bars. And the red line looks at our WTI projected prices that we get from Moody's Analytics overall. So what I think is what's going to happen is that oil prices are going to gradually trend up in line with what the survey respondents had reported there, and that is also going to make our production increase a bit too. However, the key thing to look at is look at the 2014 line when we were getting $93 a barrel on average and producing just under 100 million barrels of oil. That really had a major impact on our severance tax dollar receipts that we were receiving, because we take the production times the price, and that's one of the first determining factors in what we're receiving for severance tax dollars. When the price per barrel of oil fell by 47% in 2015, even though our production went up by 30%, our severance revenues went down just because that lower price there. 2016, we kind of had a double whammy where we saw the drop in production combined with another $6 drop in the price per barrel. So that, again, depressing effect on our severance tax formula there and our revenues that we have. Over the future, it does look a little bit more positive, but even when we get out to 2019, if we're producing a record just under 130 million barrels in Colorado at $60 per barrel, the total revenues are still going to be less than they were in 2014 when we had $93 a barrel and we're producing 33 million fewer barrels of oil overall. Looking at natural gas, this is a very similar kind of chart. This is in trillion cubic feet that are produced in our total natural gas production in Colorado. And again, the red line and the bulleted numbers show what the historical and projected natural gas price is going to be per million BTU at the Henry Hub spot price. You will see that natural gas prices are projected to increase over the next few years, and we're also projecting that our production is going to trend up gradually. It's going to take a couple years for that to happen. Again, we got to get above that $3.38 break-even price in 2018. It does look like we're going to be there, which will help to increase the level of production that we're seeing here in the state. But again, if you look at 2014, when we were getting on average $4.39 per million BTU in a fairly high level of production, comparing that to 2015 when the prices had fallen by over 40% right there. The total for severance tax formula doesn't look good overall there. The price times production fell considerably. 2016, although production was essentially flat, trended up a little bit. The price fell a little bit too, so that has a bad implication on our severance tax dollars as we go forward there as well. Looking forward there, the increase in prices will help a little bit. That's going to be incorporated in the forecast I'm going to show you in the next couple slides overall. So it's a positive thing, but I don't think we're going to get back to the 2014 highs that we saw of federal mineral lease dollars or in severance tax dollar collections either. So the severance tax formula is rather complicated, but to get there, we take our production quantity that we have overall. We have an exemption for small well exemptions. Those are our stripper wells, and then we subtract government-owned production because that gets paid into FML revenues. And then we take that production times the price. So that's what I was sharing with you on the previous slides. We do get to deduct then, or the producers get to deduct their TPM costs. And these costs have increased substantially over the past few years in light of the BP versus Colorado Supreme Court ruling that said that they can subtract more transportation cost overall. We then take that difference times their tax rate, which is a graduated tax rate, and then subtract the ad valorem tax credit overall. And that's essentially the property tax credit. This next slide is going to show you the volatility in the property tax credits. These property taxes are very important for local governments and counties especially. It funds a lot of their services that they provide. But what we see is that there's essentially a 1-year lag between when the production occurs and when the assessment occurs on that, and that production gets valued there overall. So our 2008 peak and gas and oil production actually is shown in assessed value in 2009, and same thing, that 14 peak is showing up in 2015. But you'll notice there's a $5 billion drop in assessed values between 2015 and 2016. And then it's very slow to recover in 2017 and 2018. So we expect that county government revenues are going to be reduced in 2017 and then gradually recover through 2018. This 2015 high assessed value, it also had a severe implication on our total severance tax dollars that were collected, as we can see here in our state severance tax revenue. On the left side of the black line that you see there, that's historical data. On the right line, that is the OSPB forecast. 2008, 2009, a bumper year for severance taxes. We had over $330 million in severance taxes that were collected, and then fell substantially in the following year because of that high assessed values that we had and the ad valorem credits that a lot of producers got to take. 2014, 2015, again, really high natural gas prices combined with high oil prices and rather high levels of production gave us a really good year for severance taxes. However, we had $11 billion in ad valorem credits that were being taken against that, combined with a considerable drop in both the value of the production and the total oil production as well that occurred in 2016, which is going to lead the severance tax revenues to fall to under $20 million. Now, total severance taxes collected was about $60 million higher than that, but Senate Bill 218 required about $110 million collectively to be withheld from this to fund those refunds to a lot of the producers that were claiming higher transportation, processing, and manufacturing costs in light of that Supreme Court ruling. So some of those revenues weren't available for distribution to counties and local governments and part of the direct distribution and severance tax dollars through the energy impact hearings. The good news is we expect a slight recovery in fiscal year 2016, 2017. And then as those ad valorem credits expire and as the price of oil and gas and production picks up over the next few years, we will see a pretty solid recovery in severance tax revenues. Back up to about $180 million or so over the next couple fiscal years, but it's still a far cry from where we were just in the last fiscal year there too. It's worth noting that the Legislative Council also is a forecast for these revenues as well. They are a little bit more bare. Last 2 fiscal years, they're about 30 million less. So hopefully the OSPB forecast comes to fruition, and that will mean more direct distribution and energy impact grant dollars that we have to distribute from DOLA's perspective. But we have to be aware that these are a very volatile series, due partially to the volatility of oil and gas there as well. And so that affects the amount of grants that DOLA can distribute. The other source that we get for distribution is federal mineral leasing revenues. This is collected by ONRR at the federal level, and we've seen a pretty substantial drop in this overall from our peak in 2013, 2014, where it was up above $170 million. One of the things that helps to increase these amounts in some of the peak years is federal mineral leases that we might have. So we had some big Roan leases that occurred that led to that spike that you see back in 2007. 8, 9, and then some Pawnee grassland leases that happened more recently that led to that more recent spike in fiscal year 13, 14. But then more recently, we've had to give back about $7.8 million per year of FML revenues for Roan refunds. And so that's one of the reasons why our FML dollars are a little bit lower, below $100 million there overall. But we do foresee that to be a little bit more stable, a little bit less volatile there as royalties from federal lands come in to help these. But still, they're going to be a lot less than where they were in the past. These are a major source of our direct distribution dollars. So the direct distribution might be a little bit lower there in the future as well. So with that, I'm going to turn it over to the audience for a few questions. I believe we have a little bit of time here. If you don't have a chance to get your question to me today, please take note of my email address or our website or phone number up there. I'm always happy to take a break from a spreadsheet to hear from you and to answer any questions there. And I'll be around for the rest rest of the conference too. So feel free to grab me, ask me any questions that you might have. So I appreciate your time today and welcome any questions that I can take until Kirby cuts me off here.
If anybody have any questions, we'll try to get into the microphone. Back here, did you? Right over here. Got one here, and I'll come over there.
So in a lot of your predictions, there's just a steady increase, but do you take any account of foreign affairs and to your predictions? Like if something were to happen in the Middle East, like there's a lot of tension right now, the price could, dramatically increase. So do you see that with your Colorado outlooks? Could you factor that in at all, or how would you go about kind of seeing with that prediction at all?
That's a great question, and well, the way we tend to factor that in is we subscribe to some national forecasts. The biggest of which is Moody's Analytics, and they are constantly updating their forecasts. They do it on a monthly basis, so they take into account some geopolitical tensions that we have. They look at OPEC and whether they are adhering to their production cuts there, and to see where we're going to be overall. And I think one of the bigger things that we're seeing is that we're really kind of nearing equilibrium for oil and gas supply overall globally here. So I think that's going to help to keep that oil kind of price in a tighter range overall. But you hit the nail right on the head. If there is a political or a escalation in some war or anything else that might occur in Syria or Middle East, then we could definitely see a spike in the price per oil. If we see a cutoff in any supply from some major countries, I know Libya's had some supply that's come offline recently, then that can also increase the price there as well. So we are very cognizant of it. We tend to update our forecast as Moody's updates them and pull down the newest variables that they provide. So the geopolitical risk or something that we have inherently through the companies that we subscribe to, I think they're a lot more attuned to that than we might be in Colorado. So we'll get it through our model that we do incorporate there overall, but it's something that is looked at a higher level than what we look at, but we are very cognizant of it as well. David?
Chris, you had the slide that showed the average break-even prices based on your survey. Was that survey primarily of publicly traded companies, private firms, combination of both? I think some of our producers have break-evens well below that, and I wondered what went into those averages.
It was that was from the Federal Reserve 10th District Energy Survey, and what they did was they surveyed firms, oil and gas firms that are located or headquartered within the 10th District. And you could hit it right on the head right there. And the lower range was about 250 there that a lot of the firms reported. So I don't know if many of the firms out here on the Western Slope are below that threshold there overall, but hopefully they could be right around there. And the positive is that if natural gas is around 320 where it is now, then that means that the majority of the firms out here are at a turning a profit and are at a positive price there. They do pull in firms from Kansas, Nebraska, and other places where terrain might not be as favorable or they don't have as much experience with drilling there, and so they have a little bit higher cost of production overall there. So I think that it's a wide range of firms that are surveyed right there. It should be both publicly and privately traded if they do have operations here or if they're headquartered here. But like any survey too, there's some response rate error too. So maybe if some firms felt that they might be letting out some competitive secrets or other things by saying, no, I can do it for 2.25 per million BTU there, that they didn't respond. So, it could be that there's some bias in the survey, as there always is. But, that's about the best that the Federal Reserve could come up with there. And it is an average of a broader area, too. So not just the Colorado alone, but the region that encompasses the Federal Reserve 10th District.